Welcome back. Today, I want to take you into one of the most important ideas in trading. It is a word you have probably heard many times, but most traders never truly understand what it means. Liquidity. People throw this word around everywhere. They say the market swept liquidity. They say liquidity was taken. They say price is moving toward liquidity. But if you ask most traders what liquidity actually is, they usually give a vague answer, and that is a problem. Because liquidity is not just a fancy trading concept. It is the reason your orders get filled. It is the reason spreads widen. It is the reason price suddenly spikes, reverses, and leaves traders confused. It is the reason your perfect setup can fail the moment you click buy or sell. You can have beautiful analysis. You can mark the perfect level. You can understand trend, structure, and timing. But if you do not understand liquidity, your edge becomes weak the moment execution begins. Because trading is not only about predicting direction. Trading is about understanding whether the market has enough liquidity to let you enter, exit, and manage risk without being punished. So let's slow down and look at what is really happening underneath every candle. Most beginners are told that price moves because of supply and demand. And technically, that is true, but that answer is incomplete. Supply and demand explain the result. They do not fully explain the mechanism. The real market is an auction. On one side, you have traders placing limit orders. They are patient. They are waiting. Someone wants to buy at 99. Someone else wants to buy at 98. Another order sits at 97. On the other side, sellers are waiting at 101, 102, and 103. These are limit orders. They are like vendors in a marketplace, saying, "This is my price. If someone wants to deal with me, I am here." They are not chasing the market. They are providing liquidity. Then there is the second group. These traders do not wait. They want action now. They want to buy immediately. They want to sell immediately. They do not care about being patient. They care about execution. These are market orders. And market orders take liquidity. This is where price movement begins to make sense. When an aggressive buyer sends a market order, that order does not magically move price. It consumes the sell orders sitting above the current price. It eats through them level by level. First, it consumes the seller at 101, gone. Then 102, gone. Then 103, gone. And suddenly, the last traded price is 103. People say price moved up, but really, liquidity was consumed. Price was discovered at the next available level where orders existed. The same thing happens in reverse. Aggressive sellers hit the bid. They consume buyers at 99, then 98, then 97. And now the market appears to have dropped. But again, price did not move by magic. Orders were consumed. This is the invisible engine behind every candle you see on a chart. A big green candle is not just a green candle. It is aggressive buying eating through sell liquidity from bottom to top. A big red candle is not just selling pressure. It is aggressive sellers consuming bids level by level. The candle is only the footprint. The order book is the engine. Once you understand that, charts stop looking random. You begin to see them as maps of consumption, pressure, and available liquidity. But liquidity is not only about whether orders exist. There are three qualities that matter every time you trade. The first one is tightness. This means how tight the spread is between the bid and the ask. If the spread is small, the cost of trading is low. If the spread is wide, you are paying a hidden toll just to enter and exit. A wide spread is like walking into a shop where the buying price and selling price are far apart. You are already losing money before the trade even has a chance to work. The second quality is depth. Depth tells you how much size is available near the current price. If the book is thick, you can trade larger size without moving price too much. But if the book is thin, even a smaller order can create a large move. This is why some markets feel smooth, while others feel jumpy and unstable. The third quality is resilience. This one is more subtle, but it is powerful. Resilience means how quickly liquidity comes back after being consumed. If orders refill quickly, the market is healthy. If liquidity disappears and does not return, price can gap, spike, and move violently. So when you hear someone say a market is liquid, they are not only saying there are buyers and sellers. They are saying the spread is tight, the book is deep, and liquidity refills quickly after being consumed. Tight spread, deep book, fast refill. That is what creates good execution. Click below description if you want to understand trading from the inside out, instead of only looking at candles after the move already happened. Now, this is only the first layer. Most traders think liquidity is just market liquidity. They think it means tight spreads, fast fills, and easy execution. That is true, but it is only one part of the full picture. Liquidity actually operates on three connected layers. The first layer is market liquidity. This is the liquidity you see directly when you trade. Can you buy or sell easily? Are spreads tight? Is there enough depth? Can your order be filled without major slippage? This is the layer most traders focus on. The second layer is funding liquidity. This is less obvious, but it can be even more important. Funding liquidity means whether traders, institutions, funds, and firms can access cash, margin, or leverage to hold positions. When funding conditions are easy, traders can hold positions comfortably. Funds can borrow. Institutions can take risk. Leverage is available. But when funding gets tight, everything changes. Traders face margin pressure. Firms have to reduce exposure. Funds may be forced to sell assets, not because they want to, and not because their analysis changed, but because they need cash. This is when market liquidity can suddenly vanish. Spreads widen. Depth disappears. Price moves become violent. The third layer is macro liquidity. This is the big picture. Central banks, interest rates, quantitative easing, quantitative tightening, credit conditions. How much money is moving through the system? When money is easy, liquidity is abundant. Interest rates are low. Borrowing is cheaper. Risk appetite increases. Stocks, crypto, and other risk assets often rise because capital is flowing. When money becomes tight, the opposite happens. Rates rise. Borrowing becomes expensive. Leverage shrinks. Investors become defensive. Liquidity dries up. And when liquidity dries up, markets become fragile. The best way to understand it is like this. Macro liquidity is the tide. Funding liquidity is the current. Market liquidity is the wave. When the tide goes out, the current weakens and the wave loses power. When central banks tighten money, funding becomes more expensive. When funding becomes more expensive, traders and firms become pressured. When they become pressured, forced selling can begin. And when forced selling begins, market liquidity can disappear very quickly. That is why a market can look healthy one week and completely unstable the next. Liquidity is connected from the top down. But there is another dimension traders often ignore: time. Liquidity is not static. It changes throughout the day. It changes between sessions. It changes before and after news events. It changes depending on the broader market regime. Liquidity is like weather, and your trading edge improves when you trade with the weather instead of fighting it. Think about the trading day. During the Asia session, especially in many Forex pairs, liquidity is often lower. Price may range. It may consolidate. It may move slowly. But that does not mean Asia is useless. Asia often creates the reference points for the rest of the day. The high of Asia, the low of Asia, the range. Those levels become important because traders place stops around them. Later, when London opens, those highs and lows often become liquidity pools. Then London opens. Liquidity floods into the market. Volume increases. Movement becomes sharper. Very often, London first sweeps the Asia range, takes liquidity, and then begins the real expansion. Then, New York opens. For a few hours, London and New York overlap. This is one of the highest liquidity windows of the day. This is when directional moves often develop. This is when trend days can form. This is when large participants are active at the same time. But sessions are not the only thing that matters. News events can completely change liquidity conditions. Before major events like central bank meetings, inflation reports, employment data, or interest rate decisions, liquidity often pulls back. Market makers do not want to stand in front of a violent move. They reduce exposure. Spreads widen. Depth disappears. Then the news hits. Price jumps. Stops trigger. Orders get consumed. And once direction becomes clearer, liquidity may return. This is why trading right before major news can be dangerous. You may think you have a clean setup, but the liquidity underneath the setup is weak. Zoom out even further, and you will see liquidity regimes. In a bull market, liquidity feels abundant. Dips get bought. Risk appetite is high. Buyers appear quickly. In a bear market, liquidity disappears on rallies. Bounces get sold. Buyers hesitate. Sellers become aggressive. In a ranging market, liquidity often appears at the extremes. Price moves from one pool to another, sweeping highs and lows before returning to the middle. This is why I say, liquidity is weather. You do not fight a thunderstorm. You wait for better conditions. And in trading, you do not need to trade just because the market is open. You trade when liquidity conditions support your setup. Now let's connect all of this to the chart, because this is where liquidity starts to become visible. Imagine a chart with two equal highs at the same level. Most trading videos will tell you, Equal highs are a liquidity pool. That is true. But why? Why does that level contain liquidity? Think like a trader who wants to short the market. If you enter short below those highs, where do you place your stop loss? Above the highs. That is the obvious place. Now imagine hundreds or thousands of traders thinking the same way. Their stops are all sitting in roughly the same area. And what is a stop loss on a short position? It is a buy order waiting to be triggered. More specifically, it is a market buy order. So when price pushes above those equal highs, those stops trigger. Suddenly, many buy orders hit the book at the same time. That creates fuel. The market consumes that liquidity. Then, after the stops are triggered, price may reverse sharply. To the retail trader, it feels like manipulation. They hunted my stop. But often, what really happened is simpler. The market moved toward the most obvious pool of orders. You were not personally targeted. You were part of a cluster. That same logic applies to equal lows. Traders who are long often place stops below those lows. When price breaks below, those stops become market sell orders. Liquidity is consumed. Then price may reclaim the level and move higher. This is why equal highs and equal lows matter. Not because they are magic, because orders cluster there. The same thing happens around trend lines. If many traders are long from a trendline bounce, where are their stops? Usually below the trend line. So price may push below it, trigger those stops, consume the liquidity, and then reverse back up. Round numbers work the same way. $100, $50, $1,000. Psychological levels attract attention. And where attention goes, orders often cluster. Support and resistance flips also follow this logic. A level breaks, traders enter on the retest, stops gather around the obvious area, and the first test may fail because the market needs to sweep that liquidity before making the real move. Equal highs, equal lows, trend lines, round numbers, support and resistance flips. They all work for the same reason. Humans place orders in obvious places. Once you understand this, charts transform. You stop seeing random candles. You start seeing order clusters waiting to be consumed. Click below description if you want to stop feeling like the market is hunting you personally and start reading where liquidity is actually sitting. Now the real question is this: how do you trade it? Understanding liquidity is useful, but if you cannot turn it into execution, it stays theoretical. So I like to keep the process simple. First, check the environment. Before looking for a trade, ask yourself, is the spread normal? Is the market deep enough? Is price moving smoothly or jumping around? Is there major news coming soon? If the environment is bad, wait. This alone can save you from many low-quality trades. A lot of traders lose not because their idea is terrible, but because they traded in the wrong liquidity condition. Second, map the clusters. Look at the chart and ask, where are the obvious levels? Mark equal highs. Mark equal lows. Mark session highs and lows. Mark the Asia range. Mark round numbers. Mark old support and resistance. Do not overcomplicate it. You are simply identifying where traders are likely to place stops and pending orders. You are creating a liquidity map. Third, wait for clarity. Price moving into a liquidity pool is not enough. You need to see how price behaves after the sweep. Does price sweep the level and reclaim it? That can show acceptance and a potential reversal. Does price sweep and continue strongly? That can show continuation. Does price break out and immediately fail? That may be a trap. The sweep itself is not the trade. The reaction after the sweep is where clarity begins. Fourth, execute intelligently. Use the right order type for the condition. If liquidity is stable and price is controlled, limit orders may give you better entries. If you use market orders, understand that you are accepting possible slippage, and size must match the environment. In a thick, stable market, you may be able to use normal size. In a thin, volatile market, smaller size and wider risk planning may be necessary. The goal is not only to be right, the goal is to survive execution. Let's make this practical. Imagine a crypto market during Asia session. Price forms a clean range. The bottom of the range has equal lows. That level becomes a clear liquidity pool because many traders place stops below it. Then London opens. Price drops below the Asia lows. Stops trigger. Liquidity is consumed. But instead of continuing lower, price quickly reclaims the range. That reclaim is important. It tells you the breakdown may have failed. The market grabbed liquidity and returned back inside the range. From there, expansion to the upside becomes more likely. That is not random. That is a liquidity grab followed by acceptance back into the range. Now imagine a Forex opening range breakout. Price breaks above the range. Breakout traders enter long. Their confidence rises because the candle looks strong, but then price fails to hold above the range. market falls back inside. Now those breakout buyers are trapped. Their stops begin to sit below the range. If price moves lower, those stops can fuel the reversal. That is why not every breakout should be trusted. Sometimes a breakout is continuation. Sometimes it is only a liquidity event. The difference is in the reaction. Now think about a stock approaching an old resistance level. Price breaks above it, and traders expect resistance to become support. But on the first retest, price dips below the level, triggers stops, shakes out weak hands, then reclaims the level and moves higher. Again, same story, different market, same logic. Orders cluster. Price sweeps. Liquidity is consumed. Then the real move begins. This is why liquidity is so powerful. It works across crypto, Forex, stocks, futures, and almost every liquid market because it is not based on a random indicator. It is based on human behavior and order execution. Traders place stops in obvious places. The market needs orders to move, so price often travels toward the places where orders are waiting. At the beginning, candles may look random. A wick appears out of nowhere. Price breaks a high and reverses. Support breaks and then immediately recovers. A breakout works one day and fails the next. It feels confusing until you understand the auction. Then you realize the market is not just drawing candles. It is consuming orders, level by level, cluster by cluster, session by session. And once you begin seeing charts this way, your entire perspective changes. You stop asking, why did the market hunt my stop? You start asking, where were the obvious order clusters? You stop chasing every breakout. You start waiting to see whether the breakout is accepted or rejected. You stop treating wicks as random noise. You start seeing them as footprints of liquidity being taken. This does not mean every trade will work. Liquidity is not magic, but it gives you a better lens. And in trading, a better lens can completely change your decision making. So here is what I want you to do. Open a chart. Do not place a trade immediately. Just observe. Mark the highs and lows from the previous session. Mark equal highs and equal lows. Mark round numbers. Mark obvious support and resistance. Then watch what price does when it approaches those levels. Does it sweep and reverse? Does it sweep and continue? Does it reclaim? Does it reject? Do this long enough, and the market will start to look different. You will begin to see that price is not moving randomly. It is constantly searching for liquidity, consuming orders, testing participation, and revealing where traders are trapped. And once you see that, trading becomes less like guessing and more like reading a machine. Click below description if you want to go deeper into liquidity, market structure, and how real execution works behind the candles. Because the truth is simple. You do not need to know everything in trading, but you do need to understand what moves price. And price moves because orders are placed, consumed, refilled, and swept. That is the auction. That is liquidity. That is the engine behind the chart. Once you understand it, you stop trading like someone reacting to candles. You start trading like someone reading the flow behind them. And that is when the market finally begins to make sense.